Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Micron Technology.
If you find our talks useful, please consider subscribe, like, and comment underneath. I was looking at the chart for Micron this morning, preparing for this, and I honestly felt like I needed an oxygen mask just looking at it.
It's a bit of a steep climb, isn't it?
A steep climb is an understatement. The stock is up, 338% over the past year? It is a vertical line. It's absolutely parabolic. And usually when I see a move like that, my reflex, and I think the reflex of most prudent investors listening, is to say, okay, surely I missed the boat, or this is a bubble about to burst.
Of course. That's the logical reaction.
So is this just pure AI hype, or is there actually something under the hood here that justifies a 300% rally?
It is the question on everyone's mind right now. And when you see a number like 338%, it feels unsustainable by definition. It feels like, gravity has to kick in.
Right.
But here's the thing, and I don't say this lightly. The fundamentals aren't just backing this move. In some ways, they're actually outpacing the stock price. We aren't looking at a standard chip boom here. The research suggests we are in the middle of a structural shift they're calling the AI memory supercycle.
The supercycle. I keep hearing that term thrown around. It sounds a lot like a marketing buzzword designed to sell shares at the top. We need to be careful with that.
You're right to be skeptical, and historically you'd be 100% correct. Memory DRAM, NAND, it's a brutal, brutal business.
Commodity business, boom and bust.
Exactly. It's like selling corn or oil. When times are good, everyone ramps up production, the market gets flooded, prices crash, and everyone loses money. Then, they cut production, shortages happen, and the whole cycle repeats. That is the old world.
You make a memory stick, I make a memory stick, the cheapest one wins. It's a race to the bottom.
A race to the bottom. But the supercycle thesis argues that AI has fundamentally broken that model. We are not talking about generic memory anymore. We are talking about high-performance memory that is incredibly difficult to manufacture.
So it's not a commodity anymore.
It's a specialty component, and the numbers from Q1 fiscal 2026 seem to prove it. We're looking at record revenue with 57% year-over-year growth. But the kicker, the kicker is the margins. Their profit margins have expanded to 28.1%.
Wow, that is a hefty margin for hardware. Usually in a commodity cycle, you're fighting for pennies.
It is huge, and it tells us one specific thing. They have pricing power. There is a persistent supply shortage for the high-end stuff, and buyers, the Microsofts and Googles of the world, they're willing to pay a premium because they simply cannot run their AI models without this specific memory.
Not price sensitive right now, they're performance sensitive.
Exactly that.
So they are effectively one of the very few games in town for the stuff that actually matters. But let's talk about what this looks like for the shareholder. Revenue is great, margins are great, but does that translate to actual earnings per share? Because eventually the rubber has to meet the road.
It does. And the projections are, frankly, staggering. If you look at the fiscal year 2026 earnings per share, or EPS, analysts are projecting it to spike 300%.
300%.
We are talking about earnings hitting $33.22 per share.
$33 a share. That is a massive jump.
It is, and it doesn't stop there. For fiscal year 2027, the expectation is another 35% rise to nearly $45 per share. And here is why I think the bubble fears might be overblown.
Go on.
Analysts have revised these estimates up by nearly 90% in just the last 60 days.
That is wild. Usually by the time a stock is up 300%, the analysts are downgrading it or saying it's overvalued. Here, they're saying, wait, we actually underestimated how much money they're going to make.
Precisely. The street is scrambling to catch up to the reality of Micron's cash flow. And the driver of all this isn't the memory stick you put in your laptop, it's HBM.
HBM, high bandwidth memory. We see this acronym everywhere. Let's unpack this properly. Why is this one specific acronym worth hundreds of billions of dollars right now? Why can't we just use standard RAM for AI?
Okay, so think of an AI chip, like NVIDIA's Blackwell, as a super fast Ferrari engine. It can process information at incredible speeds.
Right.
But standard memory, that's like trying to feed that Ferrari engine with a garden hose. It just can't get the data to the processor fast enough.
That's a bottleneck.
A massive bottleneck. HBM is the fire hose. It allows huge amounts of data to flow instantly. If you don't have HBM, your expensive AI processor is just sitting there idling, waiting for data.
So Micron is selling the fire hoses. But surely making a fire hose isn't that much harder than making a garden hose. Why is supply so constrained?
That's where the engineering gets fascinating. It's not just a chip, it's a 3D architecture. To make HBM, they literally stack memory dies on top of each other, sometimes 8 or 12 layers high, and connect them vertically.
They're building skyscrapers on a microscopic scale.
That's a great way to put it. And doing that without the chicks overheating or losing connection is an engineering nightmare. The yield rates, how many good chips you get per wafer, are so much lower than standard memory. That difficulty is the moat.
You can't just spin up a factory and start making HBM tomorrow.
Not a chance, which explains why they are seeing HBM revenue growth of 164% in 2026.
But technology moves so fast. Is Micron actually leading, or are they just catching a rising tide?
They are leading, and specifically, they're leading the transition to HBM4. This is the next generation. But the technical specs aren't even the most exciting part for an investor.
What is?
The timeline. Micron is shipping HBM4 ahead of schedule.
That's rare in tech. Usually everything is delayed. We're used to hearing about pushbacks, supply chain issues.
It is incredibly rare, and it's a strategic dagger to their competitors, Samsung and SK Hynix. By shipping early, Micron is locking in those massive contracts with the hyperscalers before the others can even get their production lines fully sorted.
They are securing market share when demand is at its absolute peak.
Yes.
That sounds expensive, though. I mean, developing new tech, building these vertical chip factories, that has to burn a lot of cash. Are they bleeding money to achieve this growth?
That's the standard worry, right? The growth at all costs trap. But look at the cash flow. In Q1 alone, they spent $4.5 billion on capex. That's factories and equipment.
$4.5 billion. That is a serious burn rate.
It is. But even after spending that, they still generated $3.9 billion in adjusted free cash flow.
Wait, after?
They are printing so much money from operations that they can fund this massive, aggressive expansion and still have nearly $4 billion left over in a single quarter.
That is a money printing machine. Okay, so fundamentally they are crushing it. Tech-wise, they are leading. Let's look at the stock price again. Recording this on February 14th, 2026. The stock just rallied 10%, hit $410. Pre-market wants to go higher.
It's momentous price action.
But who is buying up here? Is this just retail traders on Reddit getting excited, or is the smart money actually chasing this? Because usually institutions hate buying at all-time highs.
It's both, which is a powerful combination. On the retail side, sentiment is very bullish. But you're right, usually when retail is that excited, institutions pull back.
Right.
This time, we're seeing the opposite. The institutions are reassessing. They're realizing they are underway on the most important component of the entire AI build-out. Morgan Stanley just raised their price target from $350 to $450.
$450, wow.
William Blair initiated with an outperform rating. The big funds are looking at that HBM4 news, the fact that they are shipping early, and realizing that Micron's earnings visibility is clearer than almost anyone else in the semi-space.
They're accumulating.
They're accumulating because they see this running through 2027.
Okay, so the institutions are chasing. Let's zoom out to the macro picture. You mentioned the hyperscalers earlier. Who are we talking about, and how much are they really pouring into this?
We're talking about the giants. Amazon, Alphabet, Meta, Microsoft. And the numbers are, well, they're hard to wrap your head around. We are looking at a $700 billion AI capex wave expected just in 2026.
$700 billion, with a B. That is the GDP of a medium-sized country.
With a B. And just to break that down, Amazon is estimated to spend around $200 billion, Alphabet $185 billion, Meta $135 billion. This isn't money they might spend. This is infrastructure build-out that is already happening.
And that money has to go somewhere.
It really does. And here is the connection to Micron. Every single one of those servers needs massive amounts of memory. You cannot spend $200 billion on AI data centers and skimp on the RAM. It doesn't work.
So if they don't have the memory, their billions of dollars of NVIDIA GPUs are just expensive paperweights.
Exactly. Micron is the lubricant for that $700 billion engine.
Okay, I'm getting swept up in the bull case here. It sounds perfect, almost too perfect. And as an investor, when something sounds too perfect, my alarm bells start ringing.
As they should.
Let's play devil's advocate. What can go wrong? Because when a stock is priced for perfection, any slip-up can be a disaster. What is the bear case?
You have to look at the competition. Micron is doing great, but they are not the only ones. The biggest threat is Samsung.
A giant in the room, historically.
It's the volume leader. And they have been struggling a bit with their HBM yield, which is why Micron has been able to grab so much market share. But Samsung is currently qualifying their HBM3E chips for NVIDIA and Google.
Qualifying meaning they're in the testing phase.
Yes, they have to prove the chips work, that they're reliable. If Samsung gets the green light, if they pass qualification, they can start mass producing those chips effectively. They have massive manufacturing capacity.
And if they turn that on, they could flood the market.
They could flood the market. And if that happens, that pricing power we talked about earlier,
It evaporates, or at least it gets squeezed.
it degrades significantly. It tests Micron's leadership. And the market knows this. There are some warning signs in the financial derivatives. The put-call ratio is high, 1.25. Implied volatility is in the 97th percentile.
Translate that for us. What does that tell us about investor psychology?
It means people are nervous. A high put-call ratio means a lot of investors are buying insurance against the stock dropping. They're buying puts. And high volatility means the market expects big swings. So some smart money is hedging their bets.
They're riding the rally, but have their finger on the eject button.
Exactly. Just in case Samsung makes a big announcement.
That makes sense. But let's talk about valuation. Because usually, a chart like this, the PE ratio is something ridiculous like 100. Where does Micron sit?
This is the part that surprises people. Despite the rally, despite the hype, Micron is trading at roughly 9.7 times its 2026 earnings estimates.
Wait, under 10?
Under 10.
That sounds incredibly cheap for a tech stock. I mean, most AI stocks trade at 30, 40, 50 times earnings.
It is. The historical average for Micron is around 11 times earnings. So even after this massive run, it is statistically trading below its historical average valuation.
So the market hasn't fully priced in the earnings explosion yet.
Not even close. We are looking at a scenario where the E in the PE ratio, the earnings, is growing so fast that the P can't keep up.
That is the definition of a value play, which is bizarre to say about a stock that's up 300%. So putting it all together, what is the final verdict? What's the smart wealth score?
I'm giving this a 9 out of 10. Bullish.
9 out of 10. That is high confidence, even with the Samsung risk.
It is. The thesis is just too strong. This is a multi-year hold through the 2027 memory boom. You have the early HBM4 shipments, massive pricing power, and a valuation that is still fundamentally cheap. It's the perfect storm.
So the elevator pitch is, the demand is real, the cash flow is massive, and the stock is cheaper than it looks.
That's it in a nutshell.
So we have a record-breaking quarter, a clear technical lead, and a valuation that hasn't caught up. But we're also walking a tightrope with Samsung lurking in the background.
It's a high-stakes game.
Here's the thought I want to leave you with today. Everyone is focused on the AI chips, the NVIDIAs, the processing power. But what if the bottleneck for the next 10 years isn't the brain of the computer, but the memory? If Micron really has solved this HBM puzzle better than anyone else, they might not just be a participant in the AI boom. They might be the gatekeeper.
And the gatekeeper always gets paid the toll.
That covers our look at Micron Technology. The next big checkpoint is the Q2 earnings in May. We're expecting records across the board there, so mark your calendars.
Absolutely. It will be the moment of truth.
That's all for today's analysis. If you enjoyed this talk, don't forget to like and subscribe. Thanks for listening to Smart Wealth with Joshua.
Thanks, everyone. See you next time.